very happy new year to all our viewers. Welcome to our 10th installment of Who Moved My Investment Portfolio. To kick off another year of market views and perspectives, today I'm back with our familiar face of our series, Dharit.
Happy New Year to you too, and to everyone watching. It's great to be back and joining for the very first episode of the year.
It feels like no time has passed at all. Ready to kick things off?
Absolutely, Robin. We have a couple of key topics to discuss. So Robin, what market events stood out to you the most in 2024?
So for me, it was the Federal Reserve finally switching gears on interest rates. The Fed cut rates for the first time in 4 years in September 2024, marking the start of a new easing cycle.
What's your view on this?
We did see a reaction in the global financial markets and also from the retail investors here in Singapore who had to rethink their T-bill strategy.
Yes, since the rate hikes in 2022, a popular strategy here was to T-bill and chill, which meant parking money in T-bills and rolling them back in new T-bills at maturity. But yields have now dropped to around 3%. Coming back to you, what impact did you observe?
Well, the market wasn't completely shocked. The Fed had given plenty of guidance, and here at DBS, we saw an opportunity in fixed income since the first quarter of 2024, and this played well for us over the course of 2024.
It sure did, particularly with high-quality corporate bonds.
Why don't you take us through the other big event of 2024, November's US elections?
So, Donald Trump is back in the White House, and the Republican Party swept the board, controlling both the House and the Senate. A real red wave.
It was a huge win for them. That kind of control for the party puts them in a strong position to reshape policies for the next few years.
Investors were already positioning themselves even before the results were confirmed. They were anticipating the impact of Trump's campaign promises like potential tax cuts and tariffs. Even his crypto views.
Absolutely, and that led to some significant market shifts in the last 3 months of the year. The bond market, for instance, had a rough December as the US dollar strengthened and long-term yields rose. But the Save Up portfolio, with its focus on short-duration bonds, performed well through this volatility.
Although 2024 is now behind us, these events continue to influence our views for 2025. Robin, what are some of the views you can share with our investors? US equities and tech?
Well, Trump's back, and that means some potentially exciting opportunities thanks to the plans for economic growth. But let's be real, we have to remain cautious as it's still a bit of a guessing game. So as investors, we need to be smart. One strategy is to consider a barbell approach. Think of it as a balancing risk and reward. We look at sectors that will benefit and ride the wave of growth. At the same time, we invest in safer defensive assets as a cushion.
To capitalize on Trump's growth plan, we are bullish on US stocks. Tax cuts could really boost company profits, and in the current economic climate, we expect US stocks to continue to perform.
Exciting times ahead. But that's not all. US equities will have strong support from the Fed's monetary easing, as the central bank has no plans to pause rate cuts for the time being. Within the US market, we like the tech sector. Surprisingly, when you look back at the last 2 presidential cycles, there aren't clear winners and losers amongst US sectors. They've been resilient.
Exactly. But what is consistent is the stellar performance of the US tech stocks. It shows the secular growth potential of this sector.
Now, so far, we mostly talk about riding the growth wave. But it's equally important to make sure your portfolio stays resilient should things go south.
As we navigate the Trump landscape, the trajectory of interest rates is likely to be bumpy, given the large fiscal deficits and uncertain inflation, all while experiencing a resilient US economy.
Given this, we expect a gradual easing trajectory. Slowing growth from an escalating trade war will lead to lower central bank rates. This enhances total returns on bonds.
For fixed income, we are cautious about very long-term bonds, focusing on 2 key areas. 1. Short duration bonds, 2 to 3 years, to profit from the change in interest rate direction and minimize the risk of having reinvestment cash at lower rates. 2. longer duration bonds, 7 to 10 years, to take advantage of better returns.
Given that bond yields are back up higher, if trade tensions flare up more than expected, we do see attractive risk-reward in staying overweight in fixed income, as it provides us with some downside protection.
Just like all things in life, it's about balance. With these views, we think that we are well positioned for what's coming our way. Thank you so much for chatting with me today, Robin.
And thanks for staying with us. Now, if you enjoyed this video, please like, share, and subscribe to our channel for more updates. And don't forget to hit that bell icon to get notified about our latest videos. See you next time on Who Moved My Investment Portfolio.
Bye.
Stay updated with weekly insights from DBS.